The idea for this video came about from a previous video in which I created a trading strategy when I asked myself the question, how would you trade if you had no past data? And in that video, I created a profitable reversal strategy using 4 red daily candles or 4 green daily candles. If you haven't already seen the video, I'll link that down below. And when I was testing that reversal strategy, I noticed some Forex pairs it worked particularly bad on, as well as some working very well. But that comes as no surprise because markets like pound yen, they actually respond very well to trends on the daily time frame. And we were trying to catch reversals using that strategy. So this time, in this video, we're going to look at a different idea based on trends, and we're going to be looking at pound yen. I'll show you the basic profitable strategy or idea, and then we'll look at 3 different optimizations or studies to see how the market moves and see if we can improve on that original basic study. The basic idea is simple. We are buying breakouts of the current monthly high, and we're shorting breakouts of the current monthly low. So at the start of every new month, we wait for the first daily bar to be drawn. Then the next day, we look at that previous first daily bar and we have a high and a low. So that's our current month high and low. And then the next day, we take the breakout in the direction of whether we've broken the high. If we break the high, we buy. If we've broken the low, then we short. We might already be in a trade left over from the previous month. The trade might already be running. And if we're going to be taking a breakout in the opposite direction, we exit the already open trade and get in the new trade in the new direction. But after that first daily bar is drawn for that first day of the month, then unless the market goes completely sideways within the range of that first daily bar, which it won't, then that current month high and low is constantly changing. Perhaps it sounds slightly confusing, but it'll be very clear when we go and have a look at some examples on the charts. So let's go to the computer now, and I'll show you an example, how it works, and then we start looking at the results and making some improvements. We're going to be looking at the daily chart of pound yen, and I've got data from Oanda that goes from 2008 through to the present day. We've got data up until November 2021. And all of these tests include 6 pips, or the equivalent to 6,000 yen of costs. So let's have a look and see how the strategy works. So at the moment we've got the basic strategy on the screen, and let's just have a look at those breaks of the high and the low. So this first trade here, which is a short trade, if you notice I'll hover on this first bar, which is the first bar of the month. You'll see it's the 1st of September 2020, and we look at the high. Let's just remove that. We look at the high of that bar and the low of that bar. They're our current monthly high and low. Okay, we were already in a long trade from the previous month. So the next day we got a break, and where this little red arrow is here is the low of this first daily bar. So we got a break down below the monthly low, so we took a short trade. And then as time moved on, as the bars moved on, we're getting new monthly lows. The monthly high has stayed the same because it's the high of this first bar, and we haven't exceeded the high of that. Okay, so if we look, we carry on, we're short all the way until we get to this bar here. And if we notice, this bar here is the 1st of the month. That's the 1st of October. So now we have a new monthly high and low. The high is here, the low is here. So the next day we actually got a break of the new monthly low. But we were already short, so we didn't go short again, we just stayed in the trade. Then the next day we got a breakout of that new monthly high, which was the high of this first bar. So this little blue arrow indicates we went long. And then we stayed in the trade. We were getting new monthly highs as we were going. The monthly low stayed the same, or the monthly low stayed the same at this low here. And then it wasn't until on the 28th we actually broke that monthly low, which was the low of this. We got in a short trade there. Okay, and then the start of the month, the first bar of the month was here, 2nd of November, and we got a break of that high, so we went long there. And that's how it works. So we're reassessing the monthly high and low all the time. That's all the levels that we need to be aware of. Obviously it's much easier using software like this, but still quite an easy one to trade manually. So at the moment, this is the basic strategy, and I've just put in a 350 pip stop loss. And that's what the equity curve looks like across that almost 14 years of data. We're making almost 11 million. You've seen the equity curve. It's the long, it's the short, and let's look at the total trade analysis. 265 trades, not very accurate, typical trend following strategy. Average trade is quite large at 40,000 yen. Now I've run 3 individual tests to see how the market behaves. The first test I run is a simple exit after X bars or X days. So I've run an optimization to see what happens if we exit after 1 day, 2 days, 3 days, etc. So we'll see how that works. The next thing I wanted to look at was a fixed pip profit target. So what happens if we exit the trade after 50 pips of profit, 100 pips of profit? We can see what works there. And the last thing I want to look at is a trailing stop loss. So what happens if we trail the stop loss 50 pips, 60 pips, 70 pips behind the maximum high or low depending on what direction the trade is. Now, I've run those optimizations and you've all seen them, how they look in multi-charts. But to make it more easy, more visual, I've actually exported that data and we put them into some bar graphs. So let's have a look at the bar graphs and see how the market behaves. So here's the first result, and you'll notice it's net profit versus the days in trade. So days in trade along the x-axis, and we're using -1. That's actually what we've just seen. That's just our stop and reverse with no exit after X amount of days. Okay, 0, ignore 0 because that's exiting on the same bar. We don't want to take that into account. So everything from 1 day, 20 days, we want to see how that works. If we go more than 20 days, we're pretty much not using an X day exit whatsoever because we're normally getting into a trade in the opposite direction and we're going kind of stop and reverse like the results you see here for -1. And looking across all these numbers, nice to see that everything's fairly stable, everything fairly works. We've got the biggest profit here exiting after 4 days, although it is an outlier, and I wouldn't suggest that there was particular stability in that. To me, what I see from this picture is nothing really works better than not using an X bar exit whatsoever, using the original stop and reverse exit. And that's probably because it's a trend following strategy. And ultimately, we want to stay in the trend as long as the market's trending. And sometimes a good exit from a trend following strategy is an exit to enter a trade in the opposite direction. So my conclusion from this little study is don't bother exiting after a certain amount of days. Now let's have a look at the next study, which was the Pip Profit Target. So you see we've got net profit versus profit target. And I've done a test from using no target whatsoever, and then I've gone from 50 pips all the way to 1,000 pips. And again, nice and stable. Anything above 100, so from 150 through to 1,000 is pretty stable. 550 looks the best, but it does just look like an outlier. So probably similar story to exiting after the X days because it's a trend following strategy. We don't really want to limit ourselves. And I don't find Pip targets work particularly well anyway. So for me, for that extra little bit of gain, I probably wouldn't bother and I'd probably leave it without a Pip profit target. Next, we're going to look at the impact of using a trailing stop. And I think that's the best impact or the most positive impact of all, out of all the 3 studies. But before we do that, if you're enjoying this video, then please give it a thumbs up and maybe subscribe to the channel if you want to see more videos like this one. And if you haven't already got it, then I'll leave a link down below to my 22-page Beat the Market Strategy Guidebook, and it's got 3 free strategies similar to this, and they're 3 of you, the viewers' favourite strategies. And at the moment, if you use that link down below, you can get that absolutely free. So let's have a look at this trailing stop. So here we go, net profit versus the trailing stop. Trailing stop in pips along the x-axis. Again, 0 is using no trailing stop whatsoever. And we can quite quickly see a different picture now, can't we? We can quite clearly see that anything around 200, 250, 300, 350 does actually benefit this strategy over using no trailing stop whatsoever. So if we do want to squeeze some more net profit out of this strategy, I would suggest using something like a 250 pip trailing stop. Something I will quickly mention is when I programmed this trailing stop, just for the sake of accuracy, I actually used a smaller time frame. So you'll notice that these net profit values are ever so slightly different to the previous ones you've seen, which were programmed on the daily bars. But the impact of the trailing stop is exactly the same, regardless of the bar size I'm using. So let's select 250 pips for the trailing stop and see how it looks on the chart. So now I've selected the 250 pips and I've kept the 350 pip normal stop loss. And you can see, look at this entry here. We've gone long, got a long trade, and then we've exited at 250 pips from the most profit, which would have been the high of this bar. Okay, so we've got the trailing stop in play. We've got many more trades now. Percent profitable, slightly bigger. Average trade has come down. It would do because we've got more trades. That's the equity curve, which actually looks very similar to not using a trailing stop at all. Net profit, we've got 12 million. Comparing that to not using the trailing stop, it is only 10.8 million. So we are making a little bit more net profit. So what I've shown you is how to take a basic idea and then introduce different exits to see and study how the market performs and how those exits impact, and hopefully find something that impact in a positive way. It's not the best performing strategy out there, but the results are consistent over those 14 years. And I know some of you guys do value watching the process of how I study the markets in order to come up with some sort of a profitable strategy at the end. From the 3 different exits that we've tested, I think the only one with some sort of value is that trailing stop. Using a 250 trailing stop not only increases the net profit, but it kind of psychologically it's nicer because as the market goes in your favour, you are locking in some of that profit. As I mentioned earlier, I don't always like the fixed Pip Profit Target, which didn't work particularly well with this strategy. And the exiting after X days or X bars, while that can work very well for some strategies, like I said, it's probably because it's a trend following strategy and we want to hang in and ride that trend for as long as possible. Those type of X day or X bar exits work better on something like a reversal strategy where there's going to be a little pop in the market, and typically that can be for 3, 4, 5 days. We can tell that by doing a test like this. Anyway, I hope you've enjoyed this video, and if you have any comments or questions or suggestions, then please leave them down below. And don't forget to subscribe if you haven't already. And until the next one, this is Jared Goodwin, and thank you.